Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about HEARTFLOW INC quarterly report. HEARTFLOW Inc. offers a range of medical services and solutions through its HEARTFLOW platform. These include non-invasive diagnosis of coronary artery diseases, personalized 3D modeling of patients' hearts using AI and computational fluid dynamics analysis of blood flow, stenosis, and plaque volume and composition. The company's platform provides a comprehensive suite of services for managing coronary artery diseases worldwide. The stock price of HEARTFLOW Inc., NASDAQ, HTFL, has increased by 9.64% over the past year due to several key factors. Since its initial public offering, IPO, in August 2025, the company's shares have surged, closing at $28.67, a 50% increase above its initial IPO price of $19 per share. The successful IPO itself was driven by strong investor demand, indicating confidence in HEARTFLOW's prospects. The company's AI-driven cardiac diagnostics platform, HEARTFLOW One, has also been a major contributor to the stock price appreciation. This platform utilizes artificial intelligence and computational fluid dynamics for non-invasive diagnosis and management of coronary artery disease. Additionally, HEARTFLOW's strategic industry partnerships with technology giants like NVIDIA and Microsoft have further validated its vision. The company's market expansion plans, including the anticipated launch of PCI Planner in 2026 and the introduction of its plaque analysis platform, are also expected to significantly expand its addressable market from $10 billion to over $50 billion by 2025. Furthermore, HEARTFLOW reported strong financial results post-IPO, with Q2 2025 revenue exceeding analyst estimates and a robust cash position. The favorable reimbursement landscape, with expanded coverage from major insurers, has also contributed to the company's stock price appreciation. Overall, these positive developments have driven HEARTFLOW's stock price increase over the past year. The primary drivers of revenue growth for HEARTFLOW are largely driven by market adoption and product success. Key factors include the rate of adoption of CCTA in the market, the success of the HEARTFLOW FFR CT analysis product, and the company's ability to provide reliable, high-quality actionable data and analysis through its platform. Additionally, international expansion efforts and a growing headcount have also contributed to revenue growth. On the other hand, revenue decline is primarily driven by competition from new entrants with more resources and diversified product offerings, as well as the development of competing products or technologies that could be more effective, accurate, reliable, cost-effective, or advanced. Other factors such as changes in government payer reimbursement policies, favorable/unfavorable categorization and pricing of CPT codes, and reimbursement uncertainty from commercial payers have also contributed to revenue decline. Overall, HEARTFLOW's success is heavily dependent on its ability to innovate and stay ahead of the competition in a rapidly changing market. Net income and profit margins have experienced a decline in recent periods. Specifically, net income decreased by $32.3 million from the 3-month period to the 6-month period. Additionally, net income was negative for both periods, with a loss of $9.2 million for the 3 months and $41.5 million for the 6 months. Profit margins have also declined, with gross margin decreasing from 77% to 75%. This decrease is attributed to several factors, including reduced patient access, lower reimbursement rates, and increased competition in the market. These challenges are expected to continue affecting profit margins in the future. The company's financial performance indicates a concerning trend. Despite its efforts, the company has been unable to generate positive operating cash flow, as evident from its negative operating cash flow for the 6 months ending June 30, 2025. This suggests that the company is struggling to manage its expenses and maintain liquidity, posing potential risks to its long-term sustainability. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the company's debt level increased by $23 million due to the conversion of principal under the 2024 term loan. However, this increase was later offset when the company prepaid its debt in full for $60.1 million in August 2025. As a result, the net change in debt level is negligible. On the other hand, interest expenses have increased significantly. The company's interest expense rose from $9.7 million to $10.5 million, and from $4.9 million to $6 million over the past year. Furthermore, there was an additional increase of $222,000 in interest expense from 2024 to 2025. These changes indicate a substantial rise in the company's interest expenses. The financial performance of various segments and regions has been mixed. The Americas and Asia Pacific have shown significant growth, with a plus 10% and plus 15% increase in revenue respectively. In contrast, the Mountain View, California region struggled due to high depreciation and amortization expenses, while Austin, Texas faced challenges related to its right-of-use (ROU) assets and lease liabilities. Europe also underperformed, with lower revenue compared to Asia Pacific. The United Kingdom, Europe, and Japan regions have limited operating experience and uncertain expansion success. The management of the company is cautiously optimistic about its outlook and strategy. Despite facing regulatory challenges, potential lawsuits, and uncertainties around clinical trials, the company sees opportunities for growth through developing new products, expanding internationally, and investing in customer support. To achieve this growth, the company will prioritize research and development to introduce new products and features that increase the value proposition of its HEARTFLOW platform. It will also focus on managing risks associated with security breaches and bad actors targeting networks and data storage. The management is aware of the challenges ahead, but believes that by investing in customer support and prioritizing research and development, it can overcome these obstacles and achieve a strong return on investment. The company has made significant changes to its business structure through acquisitions and divestitures. Notably, there have been no acquisitions mentioned in any of the pages reviewed. On the other hand, the company has undergone a notable divestiture with the dissolution of HEARTFLOW International SARL, a wholly owned subsidiary in Switzerland, effective July 2024. This move marks a strategic shift in the company's operations and highlights its efforts to optimize its business portfolio. Based on the financial summary, it appears that the company has not paid dividends to common shareholders. Although there are accrued but unpaid dividends for redeemable convertible preferred shares and non-cumulative dividends are entitled to holders of certain series of preferred stock, no cash dividends have been declared or paid on capital stock. Regarding share buybacks, the company has indeed bought back shares through the issuance of 2025 convertible notes. That concludes the financial summary for HEARTFLOW INC. Feel free to comment below, and I will be happy to answer them when possible.